Why does the United States pay higher drug prices than other countries? Because America's the only country in the world where 340B hospitals mark up drug prices and PBM middlemen charge billions in hidden fees. Meanwhile, Americans subsidize the research and development for new cures. Other countries benefit, but don't pay their fair share. Crack down on the middlemen. End the free riding. Lower drug prices. Go to balancethescales.org to learn more. Paid for by Pharma.
Reality radio for a really great future. We're talking real money.
No matter what, we continue to do what we need to do to get you to do the things that you need to do better than you did them before. What in the heck am I talking about? Managing money. This is the Talking Real Money podcast, and I am Don McDonald in our Florida studio. Tom Cock is not on vacation, hanging out in the Seattle studio, the Bellevue studio, technically, because he does have the Duval studio also. And we are here to enlighten you about all of the idiocy that surrounds the financial industry. And there is so much idiocy. It's actually, in many cases, it's an idiocracy. They just rule by idiocy. For example, people who predict, and here I'm going to throw a name out from way back in the past. Remember Elaine Garzarelli?
Yeah, of course. Yeah. She was big in the 80s, I want to say.
Yeah, because she predicted like the crash. One of the crashes, 87 or something.
I want to say maybe 87, yeah. I think that's
and then
right.
she started her own funds, and she was like, shit. She never got it right again. Never.
Yeah, it was one shot. Yeah.
Right. So, but when you get it right, and you get it right at some inflection point in the markets, you get a reputation from the short-sighted, idiotic financial money media. And one of those people who got a lot of media publicity more recently, in the past 2 decades, is a guy by the name of Nouriel Roubini, or as he's known, Dr. Doom, because Dr. Doom back in 2006, well, for a while before that, he was predicting that we were going to have a big market crash. And darned if in 2008 we didn't have one. So now he's the guy who predicted the 2008 crash. However, people neglect to look at the other facets of his track record. For example, in 2020, on his own website, I have it right here, he predicted a greater than Great Depression in the early 2020s. You guys missed that one?
Yeah,
you weren't
must have
paying
gone to sleep.
attention?
Passed me by, I guess, yeah.
Yeah, I mean, there was no great... I hit my mic. Sorry. There was no greater depression in the 2020s. Well, now Dr. Roubini has come around. He's finally decided he can't... If he's going to be a stopped clock, he better be a stopped clock on the more logical side. Don't predict the markets are going to be bad. Predict they're going to be good. You're going to be right more often, right?
Yeah, and what does this say about... It makes me nervous about the future when Dr. Doom is giving up his bearish dystopian predictions and instead is now saying, wait, good times are ahead. When Dr. Doom says good times are ahead, how do you take that? And we'll talk, by the way, also about...
It's not doomy anymore.
Mr. Boone. Mr. Boone versus Dr. Doom. That's how I look at this segment. But Dr. Doom's now saying no recession. He's now saying stock market, single-digit returns. Isn't that kind of what you get most of the time? I don't know.
Yeah, usually. It's best case, we expect maybe 10.
Yeah.
But
and he's saying U.S. growth, GDP growth, 2% now, but we're headed to 4%. Productivity up to 3% annually. And by the way, he points out and wants to make this extremely clear. I'm not Dr. Doom. I'm a realist. Yeah. Now, going back, I think in 2022, he, in addition to your predictions, Don, you mentioned stagflation. He saw that coming with a huge debt crisis, inflation, high debt, et cetera. It's a severe recession. But the reason he's so optimistic about the future, maybe we should all be because of this. AI, he says, is going to be a game changer.
Right.
That's
I agree with that.
Left field. He says energy is going to take off with nuclear fusion. We don't have nuclear fusion
We have
reactors
fission,
for
but
energy.
we don't have fusion.
Yeah. And he says the markets will continue to ignore the presidents. I think he meant president, but anyway, you get the idea.
No, because he's talking forward to 2030, so there'd be more than one president.
Yeah, so we're going to keep moving forward without all that.
Here's what I think of all this. Predicting is impossible. Why do we keep asking for predictions when we know they're not possible? Yet, for some reason, our little tiny prehistoric brain stems crave some sort of knowledge that cannot be gotten.
And then on the other page, I love reading this quarterly report from the Barron funds from a guy named Ron Barron, who's really the poster child for active stock management, right? I mean, this is the Barron funds have been around for decades. Ron Barron is a legend. So I love reading his newsletter. I don't know why we get it. I guess we must have had somebody.
I was going to say,
at one point,
why do you get it?
I think we must have had somebody at some point that owned a couple of these Barron funds and they became a client. According to Bloomberg, this is from the Barron funds, Barron Partners Fund is the only U.S. equity mutual fund to outperform the QQQ ETF for the past 5, 10, and 15-year periods. Today, Barron Partners Fund remains the only fund of about 22,600, such funds to beat the QQQ ETF over the last 15 years. The only one. And here's the reason why. He lays it right out here for you. He invests in people. Barron invests in awesome people like Elon Musk. Well, then he says, well, not exactly like Elon Musk, but you get the idea. He says they question everything. They accept nothing at face value. I used to read his stuff. He goes out to the places and looks at the factories and figures out what's going on at his own. And so he goes. As I say, I love reading this stuff. They've got almost $5 billion invested in SpaceX, which is privately held. But so should we believe his propaganda here about his being able to see the future?
Here's what I find fascinating about the Barron Partner Fund. Talk about a focused investment portfolio. One, this portfolio only has 26 stocks in it. That's it. Two, its number one holding. He wasn't kidding when he said he liked Tesla. Tesla makes up 35% of the fund's portfolio.
So $1 out of every $3 is in Tesla. That's crazy.
5%. Now, when a stock like Tesla does well, when you have a focused investment like that, and your stock does really well, you make a lot of money. So since he's had a big position in Tesla, the fund has had some extraordinary growth, but it's also had some incredibly wild swings. For example, let me just pull up the actual
Well, and while
charts.
you're doing that, the number 2 holding is SpaceX at almost 19%.
Yeah, it's funny because Morningstar doesn't show that.
Interesting. Yeah, I'm looking at his newsletter. Says Tesla 30%. In this case, SpaceX 18%. Arch Capital at 8%. So very few holdings make up about 90% of the overall fund.
So when you outperform, you're going to really outperform a lot.
Yep.
When you underperform, you're going to really underperform a lot. And here's a very telling tale. Let's just go back. We're not even going to go back very far. Let's just go back to December of 2024.
That's just like 6 months ago.
Yeah.
Yeah.
Yeah. $10,000 invested in Barron's by
in the Partners Fund?
In the Partner Fund.
Partners
Hold on, I got to
Fund,
pull up the number.
Yep.
Would have been worth about $6,500 by April.
Wow. So you're down 35% in that period of time.
Ooh. Now, do you want a fund that fluctuates? That's a scarier fund than owning the entire stock market by far. And get this fund has an expense ratio. They're eating part of it right now. Their stated expense ratio is 2.25% per year.
Good money if you can get it, I guess, right? That's pretty steep. Wow.
And yet $7.5 billion is invested in the fund because of stories like that.
Yeah.
Well, they've beaten the QQQ. Well, the QQQ is 100 stocks. And the QQQ is nowhere near as volatile. This fund has, what is its standard deviation? Oh my gosh, it's 10-year standard deviation, which over 10 years, you tend to have a lower standard deviation.
Yeah, you got more time.
You got more time. Mm-hmm. Over 32%.
Yeah, and the S&P is like
15, 16.
Okay, yeah. And how about the QQQ? I bet it's fairly high too, but in the low 20s, I'm guessing? Probably something in there.
Let's see, what is QQQ in terms of volatility? Oh, a fraction, 19.
Okay.
19.
Close. Yeah.
So, yes, of course the returns are going to look better when things go well for them. And they're going to look dramatically worse when things go badly. This is exactly why we suggest you not own actively managed funds.
Yeah, and when I read the Dr. Doom versus Mr. Boone write-up, I think about a couple of things. Always, when you invest in any fund, you got to know what you're trying to achieve. In this case, I guess... with the Barron funds, you're hoping to hit a home run, right? That you're not going to be in it when it goes down 35%, because we do know, by the way, a lot of people quit when that happens.
You're wanting to hit a grand slam home run three times
money
in the game.
Yeah, and the only reason you put your money in here is you're going to, quote unquote, beat the market, which brings me to number two, and you very nicely outlined this. You should understand the risks, because with limited exposure to so few stocks, so much in just a few technologies in a way, you're going to see the ups and the downs. And for me, Don, as we have stated in the past, if you're going to use index or index-like products, you need to accept market returns. If you invest in this fund, you're saying, I'm not going to accept that. I'm going to make more. I'm special. I deserve more, and Ron's going to show me the way.
And the result will be that at times you do a lot. You do a lot better. But at other times, there's a very good chance it's going to be a painful ride. And as a matter of fact, in 2024, let me just find, I'm sorry, I'm on the QQQ again. I didn't want to be on that. I wanted to be on the Barron's Fund. Wait, that should be right here. Barron's Partners. I'm flipping around to too many funds. Barron's Partner. I want to go back to my performance numbers. And in 2024, they underperformed the market slightly. In year to date, get this. Year to date, they are down more than 7% when their index, which is like the Qs, is up 4.5%.
Okay. Yeah. Well, again, big bets, big wins, big losses. I mean, you got to expect that, right?
Right. And let me give you another one from Barron's Partners. You see, in 2022, I don't think many people would have stood this very well. In 2022, the Barron's Partner Fund lost 43%. 43%. That felt almost as bad as 2008 to those investors.
That's a lot. Yeah.
Let's compare that to the S&P 500, which lost about 18.
Yeah.
So you lost more than twice
more.
what the S&P 500 lost.
He didn't mention that in his newsletter.
Isn't that interesting? That's because here's what did it for him. He had one great year. This sounds a lot like ARK.
Yeah.
His great year was 2020, when this fund made 150%.
Because Tesla went straight through the moon.
Yeah, and the S&P 500 only did 18 that year.
Wow, that's substantial. All right, let's go on. Thank you, Ron. Thank you, Doctor, I guess, for your input.
Now, why did you said Dr. Doom and Dr. Boone?
No, I said Dr. Doom versus Mr. Boone, because he's a boon. Ron's a boon for business, right? He's going to make it happen.
Okay, that was real. I see. I'm sorry I asked the question now. I thought it was going to be some brilliant answer,
No,
but
you knew me. Then it's not going to be brilliant. You're okay
wow,
there.
That really wasn't even a bad dad joke. That was just at a whole new level. Boone.
Well,
he's a
I'm
boon to
trying.
his bottom line.
That's exactly right. I think I saw once the place he lives at some palatial. Of course, if you're charging
sure it
one
is, because
plus whatever it is.
Well,
two,
okay, you got a 2+% fees. You can
That'll
afford
do
a
it.
palace when you have billions of dollars in the portfolio.
which is what he has. All right, Jeffrey writes us from Black River, New York. He says, I'm reaching out for opinions and advice regarding my current retirement savings plan. Based off advice you gave, you talk about the need for diversifying by investing into international funds, something I'm currently not doing. He's 37. He's serving as a major in the U.S. Army, and then he walked through his accounts here. I opted into the blended retirement system in 2018 and began investing 5% of my TSP with a 5% match. He kind of goes into the dollars. 100% invested in the C fund. Now, I always forget the tickers on
C's the
this thing.
S&P 500.
Okay, so current balance there, 100,000. Then he has a personal Roth IRA through Vanguard with a balance of 118,000. Every month he adds 500 there. And he's in 3 funds. VLCAX, which I looked up, which is U.S. large cap.
Yeah.
The VMGMX, which is mid cap growth.
Yeah.
And then the VDADX, which is U.S. large. It's basically 25 or so percent of the first one, 44% the second one, and 30%
Well, yeah,
in
it's
the
the
third.
dividend appreciation fund. It's
dividend
a dividend.
appreciation. Correct.
Yeah. But it's an
So,
index fund.
yeah,
I don't like his portfolio
No,
because
I don't like his choices.
It's large cap weighted, heavily
Yep.
large cap weighted. It has no value. It has no international, which I
Yep.
think is a huge mistake. I don't care how much you love your country. Canadians love their country, and it would be foolish of them to have 100% of their portfolio in Canadian stocks.
Yeah, and he asks, which of the funds listed above would you transfer invest into an international fund such as VT, and what percentage? Probably all of it in your
All of
personal
it.
Roth. Yeah,
Yep.
I would clean that up entirely. Take the 118, put it in a global fund. That's going to
VT.
have some U.S. It's going to have some large, a little bit of small, not as much value as I'd like, but that would be a way to clean that up, Jeffrey. And you're going to, of course, be eligible for a pension because he says he's going to stay on 20 years. And thank you for your service. I don't know what else to add there, but clean up that Roth.
It would just make it so much easier to invest. You just put it in VT. Now, again, as you said, VT doesn't get us the small, but that's okay. Just owning something that looks like the market, which is what VT is. It doesn't look like the market. It's basically the market, is a whole lot better off. You're likely to be a whole lot better off in terms of volatility and a decent return than you are trying to pick the right segments of the market for the time.
Exactly.
And that's what you're really doing right now. You're trying to say, yeah, the big stocks have done better, so therefore they will do better in the future, and that's a correlation that shouldn't be made.
Yeah. All right. This one comes from Dan in Atlanta, Georgia. You may have to hold your nose a bit, Don. He says he's been an avid listener for 3 years. Appreciates all of the great advice. Look forward to new episodes and always accompany me on my commute to and from work. Recently started a new job.
What was the bad part about that?
I'm getting to that. I just started a new job, met the time requirement to start in the 401k. My wife and I have been maxing out our 401ks for several years and have transitioned into pre-tax contributions as our incomes have risen. Great. New 401k is through ADP, and the investment options are terrible. A good Don rant on these would make my day. Here's a couple of the funds. I literally couldn't believe when I looked it up. JUEZX, the JP Morgan JUEZX, the JP Morgan U.S. Equity Fund. Take a look at that one. See if you start getting some hives there, start cringing a bit, or start crying.
You've actually looked. What?
JUEZX.
I transposed.
JP Morgan U.S. Equity Fund, which comes in at a wonderful expense ratio of...
Hold
That's
on,
your cue.
It's not coming up.
Oh,
there it is.
JUEZX.
It's because I can't type.
Yeah, I knew there'd be some coughing, some wheezing, perhaps some crying in there somewhere.
JP Morgan, you think you're worth 1.2%?
Yeah, that's crazy.
On an institutional fund?
I know.
You robber barons, you.
And if that one's not bad, you could be in the nationwide S&P 500 index fund. That's where they.
Wait a minute.
It's
Nationwide?
GR
M
MRX.
RX.
GRMRX.
The nationwide S&P 500 index. So it's an S&P
Index.
500
Yeah.
fund.
Yeah, index
For
fund.
93 basis points?
As he said, you're going to cough and
Whoa,
wheeze.
Nationwide.
They're not on your side, apparently.
You should be ashamed of yourself. Peyton Manning, stop making commercials for these people.
That's
they are
how they're
not
paying
on
him.
your side. This is horrific. This is the S&P 500, which you could get from Vanguard in the form of the VOO, the S&P 500 ETF, for three basis points.
I can't even run the math what the difference is percentage-wise from
3
to 93. I can't figure that one out.
It's
Somebody's
a
smarter than
lie.
me. Yeah,
It's
big.
yeah.
He goes on to say, as you can see, the expense ratios are way too high compared to the comparable, and he mentions VTI and VOO. Want to make sure I'm thinking about this the right way. I'm going to work with my employer on different fund options. That's awesome.
Yep. Good.
You've done that before with people, Don, in the past. But in the meantime, I'm going to max my contribution for the tax benefit. Math says tax benefit this year outweighs the high expense ratio.
It
So
does.
despite the high fees and bad funds, I'm better off contributing to the 401k rather than other options. He jokingly put Bitcoin in there. Household W-2 income this year exceeds $450,000. So yeah, I'd take the break. I'd put the money in there. And then any savings beyond that, then you could do either the backdoor Roth IRA because your income is too high for a Roth, or a brokerage account and buy something far better than those awful, stinky, when you label something an index fund, people naturally assume that there's a reasonable cost to it. And then to charge almost 1% for an index fund where you're doing they're not doing any work.
You could buy a Bitcoin ETF and only pay 20 basis points. And they're ripping you off at 20 basis points.
Yeah.
93 basis points for an index fund. That is, for nationwide, that should be embarrassing.
And it's literally
That's
highway
really
robbery.
greedy. That's so greedy. And that's typical. This is why I have such a low opinion of the financial services industry, not just in America, but worldwide. It is abject greed. It's no longer just fair profits. It's pure greed. If Vanguard can make a living at 0.03%, Nationwide is gouging at 1%.
Yeah, no, that's outrageous. Hey, if you want a little help with your portfolio, let us know. Or want to ask another question, because we're getting a lot of them. We love it. There's a bunch of ways. Don's going to tell you about that in a minute. But if you want some help looking at your portfolio, determining how diversified am I? How much am I paying others? I hope it's not 90-plus basis points for an index fund. And how much risk you're taking. We run an analysis for you free. We'll give you an hour with one of our advisors, help you on your way. Simply go to talkingrealmoney.com and click on, this is going to surprise you, meet an advisor.
Now, when Tom says it, for some reason, and maybe this was from his days doing infomercials, but when he says it, it sounds like the guy.
It sounds like an infomercial.
It does. It sounds like the guy on the Saturday radio show who's saying to you, or the Sunday show.
It's all free.
Yeah, free consultation, and we'll do a complete evaluation on your portfolio, and
then evaluation on you.
Let me explain something that's different. This is really, and you're going to have to believe me.
Yeah.
I'm going to go for sincerity here.
Okay, let's hear it. Let's hear your most sincere.
Closer to the mic.
That close to sincerity. Let's go.
I can do sincerity.
Yeah.
Listen, please. We promise you something that none of these other folks are going to deliver, and that is, we're not going to push you into being a client. You see, that's what sets us apart. We really like helping people. Now, do we like it when people become clients? Sure. It would be utterly disingenuous of me to say the opposite. But do we push you to do that? Is there any pressure at all? Tom, is there any pressure at all? Just yes or no?
That's right, Don. There's no pressure whatsoever.
I just said yes or no.
Oh, okay.
Damn it.
Wait a minute.
Damn
okay,
it. I
tried,
folks.
I'm trying just a second. Let me. No.
Okay. There we go. So don't worry. You're not going to get slammed. And I hate that. I won't go to anybody who says, "Oh, free consultation." I won't, because I know I'm not going to get a free consultation.
You're going to get sold something. Yeah,
I'm going to get a sales pitch. I don't want a sales pitch. I was a salesman. I don't like getting pitched. I hate it.
It's not fun. It's uncomfortable.
I hate it. Now, I do love the fact that 5 or 6 times a week now, 5 or 6 times a week, folks, I win the Publishers Clearinghouse sweepstakes now.
Wow, 5 or 6.
I literally get 5
does
to
Ed
6
McMahon
calls
show
a
up
week.
with? That's a lot.
I get 5 to 6 calls a week.
Congratulations, you've won
And
again.
one of them, the guy was in. He FaceTimed me. God, get this. I don't know how he got my FaceTime thing, but he FaceTimed me, and he was in a shack made out of cardboard.
No.
Honest to God, in like Jamaica.
Wow.
Or someplace because he had kind of a Jamaican accent. And I said, "Is that your office?" I said, "I think it needs a little work." He hung up. I don't think he meant to face
Did you sound more like this, or was it more sincere then?
No, it was like, "Hello." Oh, he goes, "Hello, Donald Anderson?" I go,
Donald
okay,
Anderson.
if you said
Now
Donald
you know.
Anderson, you
You
don't
know
know
her.
who you're talking to. Yes, I'm calling from Publishers Clearinghouse.
Oh, yeah, right. Uh-huh.
I said, "Did I win again? Yay!"
This is my lucky day, like every other day? Yeah, okay. Fair enough.
And one of the women was smart enough to go, "Well, it's just because you haven't collected your prize yet, apparently."
It's waiting.
I said, "Yeah. Mm-hmm.
Mr.
And what do you need from me?"
Anderson, it's
We
waiting.
only need to get some personal information just to
that's it.
verify your identity.
Give that out right and left, no problem.
Don't give that away.
Yeah.
Anyway, and you can also send your questions in to us at talkingrealmoney.com, in addition to meeting with one of our advisors with no obligation and wink, wink, no high-pressure sales pitch. I'm trying reverse psychology.
That close to sincerity. Good
That
job.
close. And you can also call us every Saturday. We love call-ins on Saturday because we take those live from 3 to 5 Eastern time. Every single Saturday, I take them by myself most of the time when Tom's gone, which is most of the time now for the summer. He's just going to not be there for a while. But we will take them together, too, on Saturdays, 3 to 5 Eastern time, 855-935-TALK. And I think that does it. Is there anything else we have to
Nope, that's it. Don, thank you very much for joining me today.
present disingenuously?
Oh, that's it. Appreciate your
Well-
comments on my delivery. I love it.
Yep. I'm Don. That's Salesman Tom. And despite the fact that he can be a bit annoying, he can be helpful, too, when he's talking real money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.